Hello everybody, I'm Joseph Khateri, realtor in the state of Virginia, and welcome to part 1 of my brand new series, Section 8 Investing Masterclass. A step-by-step guide on how to buy cheap properties with as little to no money as possible and get Section 8 tenants inside of there with the government paying you monthly for them. In this series, I'm going to break down every single step needed, no gatekeeping whatsoever. I don't believe in that. This series alone could save you thousands in mistakes. So please, don't just watch this part, watch the whole series. I also wanted to say that I fully released my Section 8 mentorship program. So if you want to work with me one-on-one where I'm coaching you and join a community of fellow investors, click the link in the description. And make sure you do it soon because I can only take a limited number of students. Let's get started. So part 1 is going to be all about picking location. So it's an introduction into location selection. And I want to do as little cuts and edits of this as possible because I want to show you guys the entire thing from beginning to end. So if this seems a little bit long or just not edited fully, it's because I made a previous series where it was all cut up and, edited and fancy, and I felt that it was not as productive as I wanted it to be. It was a little more showy than I wanted. So this whole thing will be minimal edits, just some cuts. And if you see me looking to this direction a few times, it's because my notes are all in here. I'm not going to memorize everything that I need to say. So if you see me glancing, that's why. And I'm also going to be sharing my screen the entire time. Okay, so first off, how do you even pick a city? Well, there are multiple tiers of cities, so I'm going to go through that right now. So there are A tier, B tier, and C tier cities. A tier is you think of a big city and these names pop up, right? There's Miami, New York, Los Angeles, those cities, right? And in general, you should avoid these completely. In fact, most of the time you're going to avoid the entire states that these are in simply because they're too expensive. Now, you can still do this strategy in those areas, but you'll need a lot more money, which I imagine would not be too appealing for most of you. Like for example, Washington, D.C. comes to mind, right? So let's go ahead and go on Zillow and I'll show you an example of the type of properties we have in these A tier areas. So let me go on Zillow. We'll go ahead and just put in D.C. So let's clear all of the filters and we're going to go for D.C. is known for their multifamilies and their townhomes. So we'll just do multifamily. Maybe we can find an apartment complex, right? And I mean, you can see right on this right side already, we have some crazy numbers going on. So here's just a good example. I was just one of the first I saw. This is in Washington, D.C. It is 1,500 square feet. I imagine it's a duplex. Yes, renovated duplex. I mean, it looks gorgeous. These are the type of homes you'll see in these A tier areas, right? I mean, they're gorgeous homes. They're going to appreciate like crazy. But honestly, with interest rates nowadays and, you probably will only put 20% down. I imagine you'll break even on this, maybe make a little bit of money, right? But most of your money is going to come from appreciation. So, you can even see it right here. It looks like this is almost like a flip. It is a flip, sorry. So let's go ahead and see the price history. So, oh man, it's been listed a lot. So 2014, it was sold for 500. And now in 11 years, 10 years, it is close to damn double that, right? 870. So as you can tell, it is going to be a heavy amount of appreciation going on here. Now let me show you what B tier cities are. So B tier cities are cities that you might live in, you might have visited, you can vaguely recall them, right? If you were given a minute or two. But they're still a little expensive, right? So this A tier city, we're looking at like $1 million, right? 800K. So let's look at a B tier city. So like Baltimore, for example. I'm saying that just because I live in Fredericksburg, Virginia. Baltimore is about an hour and a half away. Okay, so let's just look at anything. You have homes that are like this, 625K, and this place looks great, but that's not really a good investment. Like looking at the investment pieces, we'll look for a second. Okay, this looks decent, right? 300K, 4-bed townhouse, 1,500 square feet. It looks beautifully renovated. some steps right there. But either way, this looks gorgeous and it's 300K, and this is kind of what you'd find in a B tier city, right? And that's not to say that B tier is bad. If you want some medium appreciation, right? Maybe not as much as DC, but you like appreciation. You don't want like some crazy cheap home that you're scared is going to depreciate or break down or whatever the case is. B tier cities are great. So A tier, I mentioned them, Los Angeles, New York, basically the capitals of places, right? Whereas B tier, I like to imagine is anywhere from like 200K to 500. So Baltimore, Fredericksburg, Virginia, if we're looking in Fredericksburg, I believe average home price is about 430 here. However, you can find some cheaper homes, like this one, for example. That was quick. 350. This one right here, it's a split level home, also 350. It's a 4-bed. Almost all of Texas. So I'm just naming places so that you guys can do some research into them. I'm not saying you should 100% invest in these places. I'm actually licensed, so I can't fully just say that as a realtor, but I can as a consultant in my course. So some other examples are, oh man, I'm blanking. Yeah, most of Texas, Baltimore, someplace in upstate New York, and a lot of the Midwest, if I'm being honest. So yeah, Richmond, Virginia. Now let's go ahead and look at a C tier city. So these are cities that I'll say them and you'll go, oh yeah, I guess that place exists, right? Maybe you don't want to live there. I'm sorry if you do, and I'm offending you. Maybe you don't want to live there. Maybe you're only there for work. But either way, they have jobs, they have a population. Yeah. So some examples, and maybe this is where all of you start dialing in. Birmingham, Alabama, some other place in Alabama, most of Mississippi. They rent for a lot less in that area, though. Keep that in mind. I'll teach you how to do rents later on in the video. Detroit, Michigan, Cleveland, Ohio, Toledo, Ohio. Don't look at Akron. I know that a lot of gurus say Akron. That place is flooded with investors, right? If you're going there, expect to be paying like 200K. St. Louis, Missouri. And there are some more places, but I just don't feel comfortable mentioning or recommending them. And the reason is because, there's somewhere like Memphis, Tennessee, where homes are under 100, but for a reason, right? It has the highest murders in the entire world. There's other places, like there are some in Virginia that are under 100, right? But I imagine it's 1 in 20 square miles. So it's not possible to buy it and then scale. You also want to make sure you pick a place that you imagine staying for at least 5 to 10 years or keeping your investments there for 5 to 10 years at a minimum. And there's a few reasons for that. The first is that if you end up using a DSCR loan, these types of loans typically have a 54321 prepayment penalty, which basically means that you can Google it. But first year, if you sell the house within 12 months of buying, you have a 5% penalty on your loan price and then 4321 for each consecutive year after. So in order to sell it, penalty free, and granted, these aren't big penalties, you want to keep it for 5 years. Or you can just pay the penalty, or, I could do some digging and try to find a lender that won't do a 54321, but most do, or else they wouldn't go so low in home prices. So yeah, you want to make sure that you keep the homes in there for at least 5 years on average. And it's just good for scaling. You don't want to be bouncing place to place. It makes managing a lot harder. So the next thing I wanted to talk about is HUD rental rate basics. So FMRs. And I'll read some definitions on this side. The HUD's fair market rent is the baseline for what Section 8 will pay depending on bedroom count. So I always recommend you find a place that has a 2-bed or a 3-bed that is going for at least $1,200. Just because, that's not a hard and fast rule, but I've just noticed if you can get that 1,200 marker, that's typically an okay sign that it's worth it to keep looking in the area. So yeah, and let me show you how to do that. So we'll go ahead and look at somewhere like Cleveland. Again, I'm not saying just invest in Cleveland, right? I'm saying do your own research, and this is just one of the areas. Oh man, I'm sorry. I'm gonna keep jumping from topic to topic a lot, but it's just coming up as I remember them. How do you find a lot of these cities? Like maybe you can't think of cities, or maybe you're just bad at geography. Maybe you're not from the US. You can definitely still do this as an investor, and I'll talk about how. Hint, hint, you need 35% down payment if you're a non-citizen. So it's still possible as a non-citizen, just a little bit more down payment. But let's assume you are one of those people. Okay, so how do you find these cities that I mentioned previously if you aren't familiar with US geography? Well, you can use this website called Investor Lift. You can make a new account. It's free, at least to make the account, it's free. And we're going to go ahead and just explore this website. So it'll bring up a map of the US, and you can put in the price that you're looking at. So let's say you're looking at up to 200,000. And it can give you kind of a hotspot locator. So as we see like 500 here, 114 here, 246 here, 291 down here. So we can zoom in and zoom in again, and we can kind of see what the hotspots are in red and orange. So I do see down here a red spot, 155. That is Houston, Texas. So then you can go back on Zillow and you can type in Houston, Houston, Texas. And now you can browse the homes, right? I see a beautiful, oh my God, look at this place. That's a castle. My Lord. Anyway, sorry. Here's a 3-bed for $215. You know, this is kind of what we were saying for Texas. You know, here's another 3-bed, nice place for $196. So this is good for finding cities, but if I'm being honest, do not look at properties on here, right? Because even it just feels scammy. I've never fully used this, right? So maybe I'm talking out of my ass here. But it doesn't feel right to use this. Like, it's sketchy. That's a good way to put it. So first off, you have to request the address to even like do anything with it, but that by itself is weird because they're just scraping your data for sure. That's what they're doing it for. Or, you know, it'll say 117, right? I'm sure this house is on Zillow somewhere, but win it now for 127. Clearly they're pocketing the 10K, right? At least I'm assuming. Sorry, this is all assumption. And the only way to like connect with them is by using their lender and their realtors and whoever. I don't like that. It seems sketchy. So I use it to find cities, but once I know the city, I just go on Zillow. Where was I? Yes, FMRs. So we'll go ahead and look at Texas once again. We'll look at this house right here. 4202 Oates Street, Houston, Texas. So let's say that you found a city and now you want to figure out what FMRs can go for, right? So we'll scroll all the way down and we'll find the county that it's in. Texas, Harris County, and it is 77020. You're going to go on Google and you're going to just type in HUD, FMR, and then the year. And typically the first thing is what you need. It's a .gov website. Scroll down, click here. And then you're going to go to Texas. I already forgot which area that was. Harris County. Okay, zip code 77020. Right there. So, a 3-bed is $1,450. And that is not as good as I was hoping, but I kind of figured it was just a random example. But that is how you find the HUD rates. And you might be wondering, oh, but Joseph, so you're telling me if I list it on Zillow, this is how much the government will pay me? No. No. A lot of people get that wrong, and maybe I didn't explain it well enough originally. This number is simply the maximum the government will give you for this property, right? That is all it means. It is not how much you can rent it for. It is not a guarantee, right? It is simply the government saying, hey, we'll give you up to this amount. That is all it's saying. So if you discover, right, let's go on, we can even see what does Zillow estimate. So it estimates you can actually rent it for $1,743. If you list it as $1,743, the government will only give up to $1,450. And that is if you're paying utilities. This $1,450 number includes a utility voucher, which I can also show you that as well. The way it works, and there's actually a calculation, I believe on the previous page, but that $1,450 payment, it'll actually be like $1,300 is the government rent portion, and the other $150 is a water voucher, electricity voucher, gas voucher, that make up it, right? So I don't know exactly where this Houston one is, just because I picked it as a random example. But off the top of my head, I know the Cleveland Housing Authority, I know where that one is. So if we go to cmha.net right here, and I'm just doing this to show you as an example, the rent section, where is it? Right here, utility allowance chart. So this is a very good example to what I'm talking about. So a 3-bed, right? Right here. So this website might say, you know, a 3-bed gives $1,468, right? You can see, for example, if you are paying for the trash, you'll get, if you don't pay the trash and you put on the tenant, you know, $9 will be subtracted, because they're assuming, once again, this $1,450 or $1,468 figure on this website is if you're paying the utilities, right? So another example is right here. If you have natural gas and you're making the tenant pay it, that is $62 gone, etc. Now you're probably asking, okay, Joseph, so now that we've realized that that number on this website is only what they can give you, right? What should I actually list the home for? I could list, even though this says, let's say 2,000 right here, I could list it for 3K, 4K, 5K, any number I want, really. However, the government will only pay up to 2, and the tenant has to pay the rest, right? So you kind of just treat it as any other rental. Find what the surrounding homes are renting for and just go based off that, right? So let's just look at Cleveland, just because that's what I'm most familiar with. We're going to look at this first home. I barely looked. A little rough, kind of looks, whatever. We'll use it as an example. So, perfect. Currently rented to Section 8 tenant who has been there for 4 years. All utilities are paid by the tenant. It is $950 a month that they are getting. And that way, tenant is paying all utilities. And in fact, I think that's probably a little bit low as to what it should be. But that is just an example, right? For all I know, all the homes on this street are also renting for about $1,000 for Section 8. So even though the website I was just showing you said like $1,450, that is only the maximum. That is not what you actually can rent it for. The reverse is true as well. So we'll go ahead and look at something like the AffordableHousing.com. This is kind of like Zillow, but for only Section 8. So we'll look at this exact zip code, 44108. Cleveland. All right, so 3-bed, 1,400 square feet, single family. So we'll only look at 3 beds. And we'll only look at single family residences. And we'll see what they're renting for. So we're seeing... this is a good example. 44108, 3-bed, about the same square footage, and it is going for 1,300. And it says it's a waiting list, meaning it already got applicants. Let's see, paid by tenant. Oh, they're saying, okay, all of these have to be paid by the tenant. However, the owner pays the water, sewer, trash. So it seems to be about 50-50 for the utilities. Yeah, I can't tell exactly where or when it was listed for, but I'm sure if you call the agent, you'd be able to just directly ask to see what the average list times are for this type of home. But it seemed like, okay, 1,300 was fair with about 50-50 split on utilities for that type of square footage. So again, it is not what you see on the government website. That is just how much they're willing to pay at a maximum. So if you see people listing it for 1,100, 1,200, guess what? If you put it for 14 because you think that's what the government website will give you, you're not getting a single applicant. And you might think, oh, why not? They're Section 8. Well, guess what? They still typically pay a portion of the rent. Maybe it's not the whole amount, right? But maybe it's still 10%, 20%. And with somebody only making $800 a month, 10 or 20%, that is a big difference. To you and me, it might be $50. To them, it might be a week's worth of their salary. Okay, so now that I kind of told you how to find the locations and how to figure out what you could actually rent it for reasonably using AffordableHousing.com, now it's time for the next step, which is you want to actually look into the cities themselves, right? You want to do some background research on them. So we can go ahead and look at this site that I like using, city-data.com. And you can go really specific with this website. So we were in the zip code 44108. And we can look at all of the details. So 52% renters. It looks like in 2000, the population was 36K. In 2010, it dipped down quite a bit, 25K. And it's estimated now we're at about 20K. So this seems like a declining area. What else can we see? It is predominantly black, as well as the second is white. So 88% black area. The estimated house value is 68K, with the average being 220. So if we're being honest, this is a fairly poor area. I'm just being blunt here. That's what I'm seeing. So it's up to you if you'd like to invest in an area like this. If I'm being honest, all I ever the population is a bit concerning, but what I look at most is I like to keep things simple, right? Can I get a good deal on a house? That's number one. And number two, can I rent the house at the price that I want to make my numbers work? And number three, can I do it for probably at least 5 years? That's all I really care about, if I'm being honest. Because if I can do that, then I can reliably rent it for at least like 5 years. And if I don't like it after the 5-year marker, I can do a 1031 exchange, which is when you almost trade the house for a different one in order to avoid paying capital gains tax. So, I mean, I like to keep things simple, right? I don't like to overthink these things because it'll cause analysis paralysis. I mean, maybe you don't want to choose the zip code specifically. But, that's kind of my point here. That as long as it works for you, that's really what matters. So if we choose somewhere else, like let's say 44103, there's a 76K house here. How is 44103 doing? Let's check. All right, 44103, 73% black. Second place is white. Again, home price is pretty low, 63K average. And where is the population? That's what I was looking for. Oh, sorry, right here. So this is actually doing kind of the same, if we're being honest. So the populations are dipping in this area. So that's something you want to keep an eye out. We'll go ahead and look at maybe this one, 44111. And this is a better one. If I'm being honest, it stayed pretty consistent. It's only gone down a pretty minuscule amount. In fact, it's almost the exact same from 2010. So I'd argue this hasn't gone down at all. Granted, this was a more expensive area. So that's kind of the point that we're seeing here, right? It's mostly white. Go figure, right? Okay, average home price here is 143. So I'm going too much into this, right? But my point is this website is great for looking at the details of all these areas, right? And again, all I really care about, again, in my opinion, I'm looking at this as an investor, right? All I care about is, can I rent this at the price I want for at least, 5 years, maybe 10, right? And you have to keep in mind that once you find a good Section 8 tenant, they very rarely leave. I mean, you saw the listing earlier. That tenant was there for 4 or 5 years. That they typically stay for long stretches of time once they find a place that suits their needs and isn't run by a slumlord. Before you start investing in these areas, you also want to make sure of the actual housing authority rules and regulations. So you can pretty easily find this. So let's say Fredericksburg, Virginia, right? I can just Google rental laws and boom, what's this first link? Ta-da! A full 41-page document of all the laws and regulations for landlords. And I believe, where does it say? Yeah, so it just gives every rule possible, basically. And the reason I'm even saying this is because some places will require special certifications or certificates, whatever the case is. For example, Cleveland being one of them, you need a lead paint certification. And I actually didn't know this until we got a house in Cleveland, an investment, and we ended up getting it and realizing it needed a lead paint certification only after we finished the rehab that took like 2 months. And guess what? The city said lead paint certifications take 60 to 90 days. So we messed up there, right? We wouldn't have messed up if we just called the housing authority beforehand, or even just Googled the landlord laws. So here is another place we can see tenant and landlord resources. Okay, that site's not loading for some odd reason. That's pretty weird. Whatever that is. But that's my point, where you want to do your research and even just call the housing authority and say, hey, I'm thinking of investing in the area. Could you pretty please tell me if there's any weird laws or anything? I'm not from the area that I need to be aware of. And they could help you out there. You can also call them and ask about the wait list. So you can say, hey, how long is the wait list? Do you guys have a huge influx of landlords? Like, do you have too many landlords in this area already? Or do you have not enough tenants? You could say, how long is the tenant wait list? Is there even a wait list open? And if they're saying, oh yeah, if you're a tenant and you apply, we'll get you a voucher in 2 weeks, then that is a very bad sign. That clearly means there's too many landlords. And the opposite could be true. They could say, oh, if you're a tenant, you can't even apply. We have so many people on the wait list. We desperately need landlords in order to get them more housing. That could also be true. And that is a good sign, right? Supply and demand. So now we want to make sure of inventory levels. And this is something that I see so many people guilty of that they mess up. And it infuriates me because, look, if I'm being honest, a lot of it's common sense, like at the end of the day. So let's take, what's a good example? Houston, Texas. I'm just going back to my previous examples. Let's say that you only have the budget for a house that is $100,000, right? Which is fine. That is a lot of people's budgets. We'll put a maximum of $100K, and you want it to be at least a 3-bed, let's say at least a 2-bed, right? And you want it to be a house. Multifamilies are good. However, I don't recommend it for Section 8. And the reason is because I don't typically like having Section 8 tenants share a wall, if I'm being honest. it's just kind of a headache. Plus, multifamilies rent for less, so a lot of the time it's the same returns for more headache. Each unit will rent for 600 instead of just renting a full house for 12. So I like multifamilies, but I recommend regular tenants for those. Or a lot of the times, if you have a low income or you want a house hack, they're fantastic for that. I wish I had a multifamily here in Fredericksburg to buy, but they don't exist really here. Because what a lot of people do is they use something like a 5% down payment loan to get a multifamily house. And then they'll live in one unit and rent out the rest. And I think that's fantastic. And it is what I recommend to a lot of my clients as well if you are low on cash. Anyways, we're looking at houses only up to 100K. And would you look at that? Only 28 results. Now you might think, hooray, 28 results. I can buy up to 28 homes in that area. No, you can't. 28 homes, especially this scattered, right, is going to cause a huge headache for your realtor because they're going to have to run from one area to another all across the city. But second, these homes are being bought by all cash buyers or corporations who, again, are basically all cash buyers. Like, you can even see, look at this home. 14,000 views. 14,000. And it was like posted 17 hours ago or something like that. Like, that's crazy. So clearly you are not getting this house. Like, I'm sorry, you're not. Like, we'll even look at the newest homes. So this one's 75K and 9 hours ago and 175 views already and probably 6 saves because it'll be 6 showings and it's 9 hours ago. Like, you are not getting these homes. I'm sorry. Like, I know that's a buzzkill and I know I'm being a negative Nancy, but you are wasting your own time and the realtor's time if you're trying to go for homes in this low of an inventory area. Now, you might think, okay, so what do you think is the criteria to find these? Like, what do you think the home prices are in this area? Well, I like to look at least 80 results. 80 that you could close your eyes and pick any of them, right? So, if you're set on Houston, right, let's up the price to 150. Oh, now we have 172 results. So guess what? That passes the 80 I was talking about. So that means if you're wanting to buy in Houston, Texas, chances are you're going to be hitting up to 150K, right? Like, for example, this would be a good Section 8 house right here. It's 130, right? So expect to be buying between 100 and 150 if you're going for Houston. Another example, let's do Fredericksburg, where I live. We'll start off at 100. Guess what? Nothing. Up until 150. 1 result. That's not enough. 200. 2 results. That's not enough. 250. 3 results. That's not enough. How about 300? 5 results. That's not enough. 350. Okay, we're getting somewhere. 18 results. Again, that seems like a lot, but it isn't. You're going to be beaten out here. So we'll consider 350 the baseline. Now let's see. 400? 37 results. So even that doesn't have that many homes. Let's increase it once again. 450. There we go. Now we're looking at 64. Now granted, Fredericksburg is a much smaller area. I believe you have a population of like 20 to 30,000 people. So incomparable to something like Houston. So I would say in smaller areas, you're looking at 50 results. So we are seeing, 50 results. That would probably be somewhere between 350 and 450K. That'd be your purchase price here. All right. And kind of a funny trick that I like to do. It's called, I didn't come up with it. It's called the Starbucks rule. You want to see how close the home is to a Starbucks because Starbucks likes to invest in higher appreciation areas. That's where they like to put their stores. Let's say you're interested in this home. I showed it earlier. 350K, 6,000 Oak Grove Drive. Let's go ahead and pull up Google Maps. And the closest Starbucks is 6 minutes away. That's a good sign. So if it's under 10, that's usually an okay sign. Again, this is not some random hard and fast rule. It's basically made up. I just am noticing a common trend is all. And what's probably a better indication of a strong rental is the distance it is from places like factories, hospitals, companies, etc. All right, so I also wanted to give a piece of advice, which is higher inventory means less bidding wars, and that is always a good thing, right? It's going to make the process so much easier. Now, if you want to get into these bidding wars, you can, but I don't recommend doing them until you have leverage, right? If you're doing a 3% down payment, 5%, 20%, you're going to lose almost every time. So, and I always recommend a home inspection. You shouldn't ever waive your right to one. So you can do bidding wars if you already have some properties under your belt, or okay losing the bidding wars, and preferably are all cash. Then you can do the dogfighting. And if you're also worried about investing in really poor neighborhoods, not poor by income, but just bad choice neighborhoods, or like D tier neighborhoods that you probably shouldn't even be stepping foot in, ask the realtor that I refer you to, because I will be referring you to a realtor throughout this process, especially if you join the Section 8 Mastery program I have. You'll have access to all of my connections. But if you end up getting with the realtor, they know the local area. Like, directly ask them, hey, is this an okay area to even be buying in? And they will just directly flat out tell you. Like, yes, their job is to sell you a home, right? But I interview my agents and they have repertoire with me. They're not going to give a bad recommendation, because then I'm going to stop using them. So rest assured, you can generally trust them. And once again, cheap does not always mean good, right? That's what the home inspection is for. That's what your realtor is for, to give you guidance, as well as me if you end up joining my mastery program. Cheap does not always mean good. Just because a home is listed for $60,000 does not mean it's the deal of a lifetime, right? You wanna make sure why it's a cheap price, right? Maybe it has water damage, fire damage. Maybe it's in a really bad area. You should go on Google Maps and we'll do this home as an example. Go on Google Maps and just look at the street view. And there's the home. So let's look at this area. How is it? I like to say, would you meet someone on Facebook Marketplace at 9 p.m. here? Or maybe you don't want to meet someone on Facebook. Would you go on a jog or a walk at 9 p.m. in this area? And if I'm being honest, I mean, there's a main road right here, which is like slightly annoying, but this area seems fine. I mean, it's a single family area, the cars are relatively clean, right? They're maybe not like brand new, but they're clean, which is nice. Streets are cracked, but not major potholes, no overgrown weeds on every step, right? So I would approve. I mean, come on, that looks pretty. So once again, and I'm going to read off my list here. A-tier cities, high budget, high appreciation. Los Angeles, Austin, New York, DC, lower cash flow, and sometimes break even, depending on interest rates. Higher home prices, stable home prices, and highest appreciation possible. B-tier cities, medium budget, right, like Baltimore, medium appreciation. So Baltimore, Chicago, New Orleans, Richmond, most of Texas. So medium cash flow, maybe you'll match the stock market. Medium home prices, usually stable home prices unless there's some type of economical recession, and just average appreciation, right? We're talking 5%, whatever the case is. And then there's C-tier cities, which I imagine most of you will go for. Low budget and low to sometimes no appreciation. So Cleveland, Detroit, St. Louis, Birmingham, Jackson, Toledo, like I mentioned earlier. High cash flow, low home prices, variable home prices, right? So it might dip, it might go up. That's kind of just part of the risk. And I usually say I don't bet on appreciation. I'll look at an average of maybe 3, which I believe is below average. But I'm not a betting man. I'm not a gambling man. A lot of the time I'll just say, as long as the home price stays the same, I'll be happy, right? Maybe if it raises a tiny bit just to cover realtor fees when selling. But honestly, if as long as it stays the same, that's what I care about. And again, this is a cash flow strategy that I'm talking about. It's not an appreciation strategy. If you want an appreciation strategy, that's great, but look at B tier cities or A tier cities. All right, now, the next thing we're going to talk about, forming an LLC. Disclaimer, I'm not a CPA. I'm not a tax professional. I'm not an attorney. I am just a dude who has done this before and is going to show you what I do. So that is just all I'm advising you on. So, why do you even need an LLC? That's what a question I get a lot. The reason is because it protects your assets, right? So, and that's a big reason why, as well as tax benefits and all that. But I imagine the main reason most of you will want it is just because of asset protection. So, let's say I don't have an LLC and I just buy a home in my personal name and I get a tenant in there. If the tenant slips on the sidewalk and breaks their leg and sues me in court, they can sue me and, claim my car. They can claim this house that I own, my personal home. They can go after my bank account. They can go after my stocks, right? But if the home is owned under an LLC, then they can only go under the LLC's assets, which typically is just the home itself. Meaning my car can't be touched, this personal home can't be touched. Usually only the rental itself can be touched. So, but you need to set it up properly, as well as make sure you aren't doing anything that can pierce the veil of your LLC. So there's a lot of different reasons you should get an LLC. Property repairs, you can write them off. Mortgage interest can be written off. And also, you can use them for DSCR loans, which I will cover in a little bit. So, how do you set up an LLC? It's pretty easy. So, I'll do it for Virginia just because I'm used to it. So, I like to just Google the state, Virginia LLC registration. And I actually have a separate YouTube video on this. So, click the first link. It's a .gov website. Perfect. Start a new business. Form a new Virginia LLC, 100 buckaroos. So file online. You're going to create an account. I'm just going to log in with mine. All right. So now that I'm on the website, I can go to online services, new businesses. I am filing a limited liability company. Do you have a name reserved? No. And we're just going to make one up. How about we do... Oh, and you ready? Here, I'll give you a little tidbit right here. This is something that I stupidly didn't realize a few years ago when I was making my first one of these. We'll do Khateri rentals. Yay. So if you check the availability, it'll say, you'll see, not allowed or name unavailable. Now you might think, why would that be possible? Does someone have this exact name? No, it's because I didn't put the word LLC at the end. And I didn't realize this a few years ago, and I spent like 20 minutes on it. There we go, name available. We'll click next. You can typically, I like making a new separate Gmail for everything related to your business for this rental. So put in Khateri rentals. Yay, LLC@gmail.com. This is fake. Okay, perfect. And this will be just under general, perpetual, and registered agent. So if you are filing for the same state as yourself, you typically, if you're filing an LLC in the same state that you are in, which, by the way, sorry, I should have said this earlier. You should file an LLC in the state you want to buy in, right? So if I want to buy in Ohio, I should make an Ohio LLC as a foreign entity. If I want to buy in Virginia, I should make a Virginia LLC. So if I live in Virginia, I have a Virginia accountant, and I want to buy a house in Virginia, I typically can put myself as a registered agent, or you can ask your CPA to put them down as a registered agent. However, the reason you cannot do this for out of state, so let's say I want to make an Ohio one, I can't put myself because the registered agent has to have a legal address in the same state. And that is a problem because you don't live there. So how do you go over this? Well, if your accountant is in that state, fantastic, you can try to put them down. Or you can just Google the state registered agent. And the first 10 results are just going to be places that do it for $50 a year, and you can just list their address. All right, so we'll just put myself down because I can. All right, now that we've gone to the next step, you're going to put your principal office address, basically the address you want to use for this. And I believe this one does not have to be in Virginia, if I remember correctly. But if I am wrong on that, I apologize, and it might be best to get a P.O. box in the area you want to buy in. So I'm putting just a fake address right now. Okay, management structure, manager managed. I always skip the supporting documentation, and then you simply sign it right here, review it, add it to your cart, and then pay. And that's about all you have to do. Then in your email, you're going to get a few documents. You're going to get the articles of organization as well as a receipt. And you're also going to want to need an EIN at this point. So now you can just Google EIN. I think it's EIN sign up, maybe? There we go. Okay, good enough. Get an EIN. So the IRS has an online website you can fill out. I believe it's only available, which is weird that it's only available during business hours. You'd think this is an online bot. Don't know why it can't be active during business, during any hour, but it is almost 11 p.m., so it's not working. However, if this website is working, then it basically just asks you please insert your LLC information, such as principal office address, owner of LLC, etc., as well as I think your social. And then it will simply get you an EIN emailed to you. So, hooray, fantastic. And that's about all you would need. And if for some reason it still doesn't let you, it gives you some type of error, what you'll have to do is you'll have to submit an SS4 form, and you'll have to submit it. I believe there is you can't email it. You have to actually fax it in typically, or mail this form in. It takes multiple weeks. It's very annoying. Yeah, you go to this website for instructions. I've had to do this one time, and it took weeks. It's very annoying. The online bot is so much nicer if it's working. All right, everybody, let's take a break right here. I've been recording for an hour, 6 minutes. I wanted to talk about the Section 8 Mastery course that I just opened. So it is a mentorship program, and the reason I made it, even though I have been in the past kind of opposed to making courses, the reason is because I saw all of these gurus with their Ferraris and such, basically spouting incorrect info and selling dreams, right? Marketing tactics in order to get people to sign up for their 7K course, right? Where they were giving inaccurate figures or giving strategies that simply don't really work for beginner investors or people with low capital. So I wanted to make a actual mastery program and a mentorship program that worked for a beginner, right? That wasn't scammy. I'm not selling you a dream with 40% ROI. No, I'm not doing that. You'll even see in our sales calls that we say very realistic stuff. So I wanted to say, here's what you'll get, and please listen in because you'll see the reason why it's not really just a course. So we'll help you find the best markets, pass the HUD inspection, scaling from 1 property to 10. And here's the important parts. You can DM me at any time, right? And also join a community of fellow investors. So that's pretty cool. You can directly just DM me and talk to me, and I'll help you with your issues. There's also weekly group coaching sessions. So every week we all hop in a call and I lead it. I'll answer Q&A, I'll, find deals live, etc. And you can book one-on-one coaching sessions if those group ones aren't enough for you, like for free, as long as you're in the program. So I think that's pretty cool. I don't think many other gurus are doing like direct one-on-one time because they'd rather just give you a PowerPoint and then leave you to dry. But I'm not doing that. And I think that the price is easily justified because you get these one-on-one coaching sessions, group sessions, and if I can help you save, or if I can help you even avoid one mistake, then you'll make up the cost immediately. For example, if I help you avoid a roofing mistake, boom, 10K saved right there. So I view it as an investment and a way that I can personally help you go through this process. So if you're interested, click the link in the description, and you're going to want to do this fast because I only have a limited number of slots. Because again, I am helping everyone one-on-one. I only have so much time that I can give. So now we're going to talk about financing. And I'll talk about some vocab that I'm going to use. So gross monthly rent means the total monthly rent you expect the property to generate. No expenses or anything. Just $1,400, something like that, right? I'm also going to talk about NOI, which is rent minus operating expenses. So it's minus taxes, minus insurance, maintenance, management fees, etc. Cash flow, which is the income left after mortgage payments. And this is the part that I think the gurus try to scam you. They'll say, oh my God, my property is generating 700 in cash flow. That doesn't mean 700 net. That means the 1,400 gross minus just like the mortgage payment. And nothing else. And I think that's kind of scammy and misleading. Realistically, we're going to get you like $350, $400 after net, which again is still a great return, but it's not 7. So those are what we're going to talk about. Oh, and if I just refer to just net, it's the same thing as net operating income. Okay, so how do I do my calculations? I do it 2 ways. So I like to keep things simple. I think analysis paralysis is very real and affects a lot of people. So I just literally Google rental property calculator and boom, I click the first one. And this is what I use if I'm being honest. I know. You guys might be like, oh my God, why is it so simple? It's because I like it that way. I don't want some weird complications going on. So if you want something more complex, then I use this app called dealcheck.io. Again, it's not beginner friendly. I think it honestly gives too much details that confuse a lot of people. But if you know what you're doing, then this could be a great resource. I have an affiliate link. It's going to be down below. It's right here. Dealcheck.io !FP_REF equals Joseph81. And it'll be linked below. You can just like type in the address and it'll automatically pull in a bunch of info from public records. That is such a blurry image. There you go. That's a good example of kind of how it looks like, the UI. Okay, so now we're going to talk about the 1%, 1.5, and 2% rules and what they are and why I follow them. So 2% rule simply means you can rent it for 2% of the purchase price. So if you buy a home for 100K, you want to aim for 2,000 in monthly rent. However, you can only typically hit this with a BRRRR strategy: buy, renovate, rent, refinance, repeat. It's very hard to hit with just like a turnkey property. The 1.5% rule, I think, is probably the benchmark most of you will use for turnkey properties or close to it, where you're not doing some crazy rehabbing. Again, it's the same thing, just you can rent it for 1.5% of the purchase price. So if you buy a home for 100, you can rent it for 1,500. Or the 1% rule, which I think is more for like B tier and A tier cities, where you're also going to get some appreciation. So yeah. And I have in my notes, show comps. I already showed you how to do comps. You go on affordable housing in order to figure out what you could realistically rent for. I showed you utility allowances. Sorry, I'm just going down this list here. Okay, yes. So, strategies for the utilities. You have 3 options. Number 1, pay utilities yourself. You most likely will get the most amount of money possible from the government. However, there is a downside, which means the tenant could end up spiking usage, right? They fill up their pool with a hose, then suddenly your water bill is $800. Downside to this, that's the downside. Upside is that there won't be liens against the property. So if the tenant doesn't pay their water bill for enough time, the water company or government can actually put a lien against your property. And that means basically when you go to sell the property, they get paid first. The unpaid bills get paid first before you get a cent. And that sucks because guess what? They weren't originally your bills. They're the tenant's bills. But suddenly now you're paying for them, right? Option 2 is have tenants pay. You'll get less from the government. That's kind of the main thing with this one. You'll get less from the government, and the problem is liens can happen, right? If the tenants pay and decide not to pay the water bill, then guess what? A lien can happen. Whereas if you pay your utilities yourself, you won't get liens because you're paying the utilities. Or you could do a hybrid approach, which I like, but you have to ask the housing authority if it's possible. Some areas will let you, some won't. Where you basically say, hey, can you give me the voucher for example, the water voucher, $50 water voucher? Can you give it to me directly, not to the tenants? And then can I write into the lease that I will only cover up to the voucher limit? So I can write in there in the lease, landlord will only cover the $50 allotted water voucher that HUD provides, something like that. And anything above will be paid by the tenant. So you have to check with the local realtor as well as the housing authority if you can do that. But if you can, that's the best bet. Because guess what? If they no longer, let's say it's a $60 bill and you can only cover $50, that $10 you have to collect from the tenant. If they owe you that money and never pay, now you have grounds for eviction. So you can evict them in that case. Whereas if they don't give that $10 to the water company, then guess what? The water company is just going to put a lien on your house and you're going to have to pay it. Sorry about that. My phone died. I didn't even notice. All right. So now I'm going to go over some key variables as to what is going to hit your cash flow the most. Mortgage payment, which is based on your down payment and interest rate. Taxes and insurance. Maintenance and reserves. And then property management. So maintenance and reserves, I like to put in like 10% monthly of the gross rent. And property management is typically 8 to 12% of the gross rent. So now I'm going to do an actual case study on this. I'm actually going to literally do an example live to show you guys that I actually do this and know what I'm talking about. So we'll go ahead and look at, just because I like picking different areas, we're going to look at Detroit. So we're gonna look at 100K. Oh, I want to mention something that I forgot. Sorry, I keep bouncing around. There are not that many homes under 100K. Across the entire US, I think there's about 1,500, give or take. Out of those 15, how much need rehab? How much we're in fires and aren't really fixable? Probably a lot. So my point is, there's probably going to be more than 1,500 people that view this video, hopefully. So what does that kind of mean? Well, that means some of you will have to dogfight, right? And you're not going to be able to be, pretending that, or not pretending, you're not going to be able to do these like, oh, let me lowball them, right? No, that's not a thing with homes under 100. Like unless it's a home nobody wants, in which case you probably shouldn't go for it either. Like for example, this 80K home right here in Detroit, chances are you're going to have to pay full price and even compete with some people for this home. Because guess what? 80 homes under 100 just aren't that common. They aren't. I'm sorry, they're not. They just aren't that common. And I wish they were more common, but they're not. So you can't realistically say that you're going to I'll offer 65. I'll offer 75. No, you're going to offer 80, and you're not going to waste my realtor's time. You're not going to waste your own time. You got to say your expectations correct, right? If this home was clearly overpriced and the realtor is saying so, right? Like, let's say this was 250 and it's probably only actually worth 200, then yeah, you could offer like 200 and go with the realtor's recommendation. But if the realtor is like, yeah, you got to do full price, then guess what? You're doing full price. Okay. So I want to point that out. I got a lot of people who I refer to my realtors, and my realtors are like, yeah, so I'm showing them 90K homes and they're offering 85, 80. And we've put in 10 offers and I know they're not getting accepted any because they're lowballing. Like, we're in a full price market. So don't send me this lead again. So I'm begging, just be aware of what you're getting into. All right. So anyways, I'm sorry. I went on a tangent there. So let's look at, I'm on the newest of this. So at least 2 beds, and we'll look at only single families. So we're going to go ahead and do some calculations live. We'll say, I'm just trying to find one that I like. How's this one? Oh, okay. This one looks good, right? Maybe needs some light rehab. I'm not going to lie. You know, it looks like the cabinets need a little work done. The floors look okay. They do look a little scratched up. I'd definitely make sure the realtor takes a good look at the flooring. But let's just try this one out, right? And it also doesn't have a garage, which is nice. I don't like garages because almost always the tenant just fills it with garbage and it becomes like a hoarder situation. So let's go ahead and see, what zip code is this? What area? Michigan, Wayne County. Okay. So we'll go on the HUD website. Michigan. Wayne County. This is a, what was this? 3-bed? 2-bed. And zip code is 448 or 48205. I've been recording in a while. I'm losing my voice. A 2-bed will go for $1,250, right? Yes, that is a 2-bed. So $1,250, and we'll go ahead and keep that in mind. So purchase price, 75. 20% down payment, we'll say an 8% interest rate. Closing cost is around 7 on average. We'll say you put 10K into rehab. So now it's worth 85,000. Perfect. And scroll down, we can see the monthly payment section, and we're looking for taxes. So it'll say $1,170 a year. By the way, these are estimates. If you want the actual 100% correct value, you can go on the public records page for this county. I'm not doing that because I'm fine with estimates. So it is saying taxes is 1,170. Insurance, I'll say 800. Just because, again, just based on like averages, that is what I typically see. Maintenance, we're gonna go with 10% of the rent. So we'll actually leave this blank because we don't know what we can rent it at, as well as other costs for now. So monthly rent. Now let's figure this out. We know the government will pay a maximum of $1,250, but let's see what we can actually reasonably rent it at. So we'll go to this zip code on affordable housing. By the way, here's actually a nice thing that I forgot to mention. If you go to the owners tab and market rent estimator, you can just type in the address, and honestly, it's fairly accurate. There we go. Morang Ave, Detroit. Yes, 2-bed. I like to pick the lowest value out of these. Okay, so it's looking like about 1,000. That seems fine. So we'll go search for homes, 48205. Yes, okay. 48205. And now we're going to go ahead and see what 2 beds go for. Property type is a single family. 1,000. Okay, so it's looking like $1,000. And let's see. Everything's paid by tenant on this one. What about this other one I just saw? Which actually has a wait list, meaning it already has applications. Oh, did I miss it? Did I just scroll past it? All paid by tenant. Okay. So $1,000 and there's no payment by the landlord. Okay, so maintenance, we'll say $100 a month, that's 10%. All right, let's calculate. Oh, I'm sorry. And let's say you hire management at 10% as well, which is average. Vacancy rate, we'll put 5, and it's because that is on average what I'm seeing. It might take like a month or two to rent, but then that tenant might stay 3 to 5 years. So it averages to be 5. Oh, wait, whoops. Did I miss one? Oh, whoops. 0. Okay. So this seems like a pretty normal return. And I like to see it. So yes, this number definitely seems low, but I don't like looking at this number because it's honestly kind of misleading. And again, it's why I don't like the cash flow. I like the ROI, and we're getting a 15.71 return for ROI, which is fantastic. The stock market averages 9. So we're beating it by a pretty wide margin here. That is a solid rental. Yes, again, it says 242 for the cash flow after, everything. But again, it's just not that, what's it called? Oh yeah, you're only putting in 32K, which sounds like a lot. But again, for rentals, that's not that bad, right? Because if you want to buy like a 400K house, right, 20% down will be $80,000. So 32K in order to get about $250 a month, that's fantastic in my opinion. And again, I'm sure that if I did some more digging, I looked for 20 seconds through the Zillow link, I'm sure I could find some other homes that, rent for like $1,300, for example. I mean, I even saw when we were looking at Cleveland. So let's say I could rent it for, the $1,250 I saw. Then yeah, we're looking at like $450 then. So again, for me looking for 15, 20 seconds, I think I did, I found a pretty good property, 15% ROI. So I'm happy with that. Okay. And now time for pretty much the last section, which is the actual loans itself. And I've been yapping a long time. I am tired, so I'm sorry if my voice doesn't have it in me anymore. Let me go ahead, and I actually have like a cheat sheet for this that I'm going to provide. I'm going to put it on screen just so that I can kind of show you and you can visually see what I'm talking about. For most loans, there's a minimum purchase price of $75K. That's just how it is. Anything lower is typically bought with cash, like I mentioned, or you're doing a burst strategy, which means you're doing private money at first. I have private money lenders, by the way. But if you're going DSCR, yeah, typically it's $75K. Or conventional, even most conventional is $75K. So here is kind of the weird checklist I have. I'm very like type A. If you have over 700 credit, at least 27K in cash, a good debt to income ratio, have a steady income according to your 2 years tax returns, then you're going to probably go for a conventional 20% down payment loan. Keep in mind for this one, you cannot use an LLC typically. A lot of the time, if you want to go conventional or FHA, they'll ask for 2 years of tax returns for the LLC, which you typically don't have because you just made it. So if you're going conventional, just keep in mind you usually can't use an LLC to close. You usually have to wait for something called a title seasoning period to end, which they'll just tell you how long that is. So it could be, 6 months, a year, never. You just have to ask the lender. All right, so second, if you have 660 credit, 27K in cash again, at least 6 months of cash reserves, you don't want your income checked, you want to use an LLC, and you're okay with a little bit higher interest rate, usually 1.5% higher than what's on the market, then we're looking at DSCR loans. 80% of you will end up doing DSCR loans. I have a guy who does DSCR loans in almost every state. Just FYI. I'm saying because it helps me, it helps my network, it helps you because you're using a trusted person. If you need a DSCR loan, right, just join my mastery program. You'll get access to the guy, all right? You're not going to have to go digging around for anybody. So just saying. And this next point is for non-US citizens. You can still invest. It'll require 35% down payment though, and typically a 100K purchase price. So they're not going to check income. You can use a new LLC once again. The main difference is simply the 35% down and 100K purchase price. Next, if you have pretty much no cash, but at least a 580 credit score, 650 is preferred, but 580 is the minimum. Not much cash at all. You haven't bought a house in the last 3 years. And this is the important part. You're okay with living in at least one of the units for a year. And you have at least a steady income. It doesn't have to be a huge income, but it's just steady. Then you can get an FHA loan at 3.5% down payment. Or if you want to buy a multifamily home, you can get a 5% down payment loan. Again, you have to live there for 1 year, at least in one of the units. So, but this method is going to be the lowest amount of money possible. All right. Now, if you have 700 credit, but you also don't have much cash at all. So the main difference here is the credit scores. You haven't bought a house in 3 years. You're okay with at least living in one of the units for a year, have a steady income. Then you'll be doing a conventional 3% down payment. So again, the main difference is the credit score, but I like the conventional 3% more because with FHA loans, you need PMI, which is private mortgage insurance. And typically it's a little bit higher with FHA loans. And the only way to get rid of it is a refinance. With conventional 3%, you can get rid of it at any point as long as you have 20% equity. So I prefer conventional 3%, but you do need a better credit score. All right, and finally, if you have a 620 credit score, a large amount of cash, super high risk tolerance, it's the riskiest strategy. You've done rehabs in the past, you're familiar with construction, and you're okay with basically having the home become a part-time job, and you want to scale as fast as possible, you're looking at private money into a refinance loan. So it's a BRRRR strategy, and I have a video on that. So it's buy, renovate, rent, refinance, repeat. So you're going to buy a house that's cheap, 50K, whatever, using private money. You're going to put, let's say, 20K of rehab into it. So it's now 70K you're into it. But then the bank appraises it at 110, just because you did such a good job rehabbing. And now the normal appraisal value is 110. Now you can refinance using a conventional or DSCR loan, keeping in 20% equity, taking out 80%, and that 80% will pay off the private money, make up your rehab costs, and give you a little nest egg for the next property. That's the fastest scaling, heavy risk. Okay, so I'm recording this while I'm editing the video because I realized I forgot to mention a pretty important part, which is once you pick one of the loans that you want to do, or however you want to finance, then join the course and I will hook you up with those lenders. I will get you in contact and get you to fill out an application with whatever lender you need. So if it's conventional or DSCR or FHA, join the course and I will get you those contacts, get you those applications you need. And then once you fill out the application, which I'll guide you through as well, you're going to get a pre-approval letter. And then you're ready for the next step. So once you have the pre-approval or the secured financing, then we're ready. I don't know why I forgot to mention that. All right, and now let's go over creative financing. There is a few methods. All cash, it's not creative, but it is the strongest offer and less headache. There is seller financing. As you can see, do not recommend this. It is simply too difficult to find a seller financing deal in this market. I 100% think that. And I feel so bad that people are still watching my video from like 2-3 years ago, and where I do recommend seller financing. It just does not work anymore. Seller financing, people have kind of become wise to it, and they know that like it's just not a good deal, right? Because seller financing in this market, it is on the seller's terms. So if you ever find a seller financing deal, first off, most people will think they're a scam, so they won't even offer it. They won't even pay you any attention. But second, even if they are willing to think about seller financing, it's going to be on their terms. 12% interest, a 10-year loan instead of a 30-year loan, right? These people are 70 years old. They're not going to want a 30-year loan with you. So it's just not recommended, and I can't recommend it in good faith. All right, and another creative financing option is partnering with people. You can do this in my Section 8 mentoring program. You can find people to partner with. Or if you don't like partners, which is totally fair, I don't really like partners. You know, you might know a doctor friend in real life who has a chunk of money, but they're too busy to invest personally. You know, you could partner up with family, etc. I firmly believe like 80% of you will end up just doing a DSCR 20% down payment so that you can use an LLC. So I believe that covers most of you. Some of you with lower cash might end up doing an FHA or multifamily or conventional, and that's okay. But I think most will fall into this DSCR 20%. And I don't like partners, if I'm being honest. You guys can, but I honestly think that most of what you need is just some mentoring. So, moi. Anyways, I have a headache. I'm like a little bit dizzy. I've been recording for almost 2 hours now. Oh my lord. My phone has died like twice. I had to feed my cat. I'm tired. I'm ending this video here. By now you should know how to pick the right market, make an LLC, how to pick the right area, how to do the calculations, how to figure out what rents you can rent it at, and what kind of financing is best for you. So just one last time, if you are interested in one-on-one mentoring, click the link in the description, join my new mastery program. I can only accept a limited number of people. And if you're looking for DSCR lenders, or conventional lenders, etc., realtors, join my mastery program because I give those completely for free in there. And you know, I vet everyone. So I think that's it. Wait for part 2. Hopefully that'll come out in a week. I'm back. I'm trying to upload every Monday. And yeah, I missed you guys. So as always, I'm Joseph Khateri. Subscribe if you haven't already, and follow for more.